We often hear about economic indicators and their impact on gold prices. At first glance, these indicators may seem complicated, especially with all the abbreviations and technical language, but in reality, they are much simpler than they appear. Most economic indicators influence one key thing: expectations about interest rates. And interest rates have a deep relationship with gold prices. For example, when investors begin to fear an economic slowdown or recession, markets start expecting central banks, especially the US Federal Reserve, to lower interest rates in order to stimulate the economy. Lower interest rates generally weaken the dollar and reduce the attractiveness of interest bearing assets such as bonds. As a result, many investors turn toward gold as a way to preserve value during uncertain times. In many cases, markets react not only to economic events themselves, but to the fear and anticipation surrounding them. This is why recession fears often affect gold prices even before a recession officially begins. Understanding this relationship between economic indicators, interest rates, and investor psychology is the key to understanding how gold reacts to economic data. And once you understand that connection, most economic indicators becomes far less intimidating than they first appear. Why do gold investors fear interest rates hikes so much? Because gold pays no interest. When central banks raise interest rates, investors can suddenly earn higher returns from banks and bonds with lower risk. That makes gold less attractive and gold prices often fall. But when interest rates are cut, everything changes. Saving accounts and bonds becomes less rewarding. The dollar often weakens and investors begin moving back toward gold. This is why interest rates are one of the most important drivers of gold prices. In simple terms, higher interest rates usually pressure gold downward. Lower interest rates usually support higher gold prices. Did you know gold and US dollar usually move in opposite directions? Gold is priced globally in US dollars. So when the dollar becomes stronger, gold becomes more expensive for international buyers. Demand can weaken, and gold prices often fall. But when the dollar weakens, gold becomes cheaper around the world. Demand can rise, and gold prices often move higher. This inverse relationship between gold and the dollar is one of the most important connections in financial markets. Strong dollar, weaker gold. Weaker dollar, stronger gold. GDP stands for Gross Domestic Product. It measures the total value of goods and services produced in an economy. In simple terms, it measures economic growth. Strong GDP growth usually signals a healthy economy. When the economy grows strongly, central banks may raise interest rates to prevent overheating and inflation. Higher interest rates can pressure gold prices downward, but weak GDP growth or economic contraction increases fears of recession. This often leads markets to expect future interest rates cuts, which can support gold prices. So, strong GDP can pressure gold, weak GDP can support gold. Why does inflation data move gold prices so aggressively? Because inflation threatens the value of money itself. CPI, or Consumer Price Index, measures how fast prices are rising in the economy. When inflation rises, many investors turn toward gold to protect their purchasing power. But there is another side to the story. High inflation also pushes central banks to raise interest rates, and higher interest rates can pressure gold prices downward. This creates a constant battle in the gold market. Fear of inflation supports gold, but aggressive rate hikes can pressure it. That is why CPI reports often create major volatility in gold prices. Why do gold traders pay so much attention to one jobs report every month? Because the non farm payrolls report can completely change market expectations. NFP measures how many jobs were added or lost in the United States, excluding farm workers. Strong job numbers usually signal a strong economy. A strong labor market can increase wages and inflation pressures, encouraging the Federal Reserve to keep interest rates high or even raise them further. That can pressure gold prices downward. But weak payroll numbers suggest economic slowing and possible future rate cuts, which often support gold prices. This is why NFP days often create huge volatility in both gold and financial markets. The unemployment rate measures the percentage of people actively looking for work but unable to find jobs. Low unemployment usually signals economic strength, but if unemployment becomes too low, wages may rise too quickly, creating inflation pressures. Central banks may then raise interest rates to cool the economy. That can pressure gold. On the other hand, rising unemployment signals economic weakness and recession fears. Markets may begin expecting interest rate cuts and stimulus measures. That environment often supports gold prices. So even a simple unemployment number can strongly influence the direction of gold. PMI stands for Purchasing Managers Index. It measures business activity in manufacturing and services. Managers are asked whether business conditions are improving, unchanged, or worsening. A PMI above 50 generally signals economic expansion. A PMI below 50 suggests economic contraction. Markets pay close attention to PMI because it provides early signals about the direction of the economy. Strong PMI data can support expectations of higher interest rates, which may pressure gold. Weak PMI data can increase recession fears and support gold prices. PMI is important because it often shows economic changes before many other indicators do. At first, economic indicators may seem complicated and disconnected, but in reality, most of them revolve around one central question. Will this data push central banks toward higher interest rates or lower interest rates? And once we understand the direction of interest rates, we can better understand the likely direction of gold. That is why understanding economic indicators is not about memorizing numbers. It's about understanding the relationship between the economy, interest rates, investor psychology, and gold. And once we understand that relationship, economic indicators become far less intimidating than they first appear. This is Old World Bullion from Europe. See you next time.